Welcome to the Deep Dive. Today, we're really digging into the Q3 2025 earnings call for FB Financial Corporation. That's ticker FBK.
Yeah, this was definitely a key quarter to watch. Q3 was really the first clean look we got at how things are shaping up after they merged with Southern States Bank shares.
Right. So our goal here is to get past just the headline numbers, the beat itself, and really understand the operating leverage, how that integration is actually going, and what management's signaling for 2026.
Exactly. And the market reaction was, well, pretty positive. It seemed to like what it heard.
It did. So this deep dive is really about figuring out why. It feels like more than just hitting the numbers. It's maybe a sign the whole merger idea is actually working as planned. Let's start with those headline figures.
Okay, yeah, the numbers definitely set the tone. Adjusted EPS came in at $1.07. That was comfortably ahead of the consensus estimate of $1.03.
So about a 3.9% beat there. Nice surprise.
Definitely. And it shows good underlying performance.
What about the top line, the revenue?
Revenue also came in at $173.9 million. That's about 3% over consensus. But the really striking thing, just to give you a sense of the scale change from the merger, is that it represents 94% growth year over year. Huge jump from $89.5 million last year.
Wow, 94%. That really underscores the transformation.
It does. But if you want the metric that really tells the story about core profitability right now, you've got to look at the pre-tax, pre-provision net revenue.
PP&R.
Right, PP&R. That strips out loan loss provisions and taxes, gives you that core operating profit picture.
Yeah.
Why is that one particularly important, you think, right after this big merger?
Well, it's just the cleanest measure of the operating leverage they're getting from combining the two banks. It cuts through noise like, credit cycle stuff or one-time merger costs, and just shows the earning power of the core franchise.
And how did they do on that front?
They delivered $81.0 million in adjusted PP&R. That's up a massive 38% just from Q2. Sequentially. 38% sequentially. Okay, that kind of immediate jump really does suggest those scale benefits everyone hoped for are, materializing and quickly.
Exactly. It's happening faster than many might have modeled.
Yeah.
And you see that momentum flowing through to the net interest margin too. The need AM hit 3.95%.
Which is up, 27 basis points from Q2's 3.68%? That's a really significant move quarter over quarter.
It is a big move.
Yeah.
And when you pair that margin expansion with some decent expense control, we can get into that more. You see the payoff in the efficiency ratio.
Ah, right. How did that look?
The adjusted core efficiency ratio improved quite nicely. Went from 56.9% last quarter down to 53.3%.
Okay, so almost a 4-point improvement. That's textbook merger execution, isn't it? Better margins, better efficiency.
Pretty much exactly what you'd hope to see. It suggests the integration is going smoothly, at least operationally.
Okay, so let's unpack that integration story a bit more. As you said, Q3 is really the first quarter where we see the combined FBK and Southern States operating as one unit. The deal closed July 1st, and crucially, they got the systems conversion done by September 2nd.
Yeah, the speed there is pretty impressive. That's often a sticking point in bank mergers, this systems integration.
Definitely. Taking down one core system and moving everyone onto another in, 2 months? That takes some serious focus.
It does. And you see the immediate impact on the size of the balance sheet. Loans held for investment, HFI, jumped to $12.30 billion. That's up from $9.87 billion in Q2. Deposits climbed to $13.81 billion from $11.40 billion. So the platform is scaled up. Now it's about optimizing it.
Right. Let's talk optimization then, starting with that net interest margin, the 3.95%. You mentioned it was partly structural, driven by the SSBK deal itself?
Yeah, that's a key point. A big driver was simply bringing SSBK's loan book onto FBK's balance sheet. SSBK's loans had a higher average yield going into the deal, something like 6.77%.
Okay, so just blending those higher yielding assets in naturally lifted the combined entity's overall asset yield.
Exactly. It provided an immediate structural lift to the NIM. But we do need to be careful with that 3.95% figure for Q3 itself.
Why is that? Some one-time items boosting it.
Precisely. There's always purchase accounting accretion noise after a deal. In Q3, the 3.95% included about $6 million in sort of normal net purchase accounting accretion. But the big thing was they recognized an additional $10.5 million in accelerated accretion items.
Accelerated, meaning they pulled forward some interest income that would have normally been recognized in future quarters.
You got it. So that $10.5 million gave the Q3 NIM an artificial one-time boost. You can't expect that specific chunk to repeat every quarter.
Okay, that makes sense. It's like a sugar high for the margin. So what's the real sustainable level look like then? What's management guiding to?
This is where their forward guidance becomes really important. They gave a pretty tight range for Q4 and looking into 2026, 3.80% to 3.90%.
3.80 to 3.90. And that range holds even with the market expecting, maybe a couple of Fed rate cuts next year.
That's what they're saying. They expect that range to hold, yes, assuming 2 cuts. They believe the underlying structural benefit plus some other optimization moves will keep the margin strong.
What other moves are helping there?
Well, they paid down $100 million in higher cost subordinated debt. They also called some trust preferred securities. These moves only really provided 1 month of benefit in Q3.
But they'll provide a full 3 months of benefit in Q4 and beyond.
Exactly. So those cost savings on the funding side help offset the disappearance of that $10.5 million accelerated accretion boost we talked about.
Right.
It helps support that 3.80 to 3.90 guide.
Okay, got it. Let's switch to the other side of the profit equation expenses. We know Q3 had that big $16.1 million chunk of merger and integration costs tied to the system's conversion. But the underlying adjusted efficiency ratio is the key, and that improved to 53.3%.
Right. That improvement is a really positive signal about how cleanly the integration is progressing.
Yeah.
And importantly, they mentioned they're actually ahead of schedule on realizing the cost savings, the synergies.
Oh, what did they say about the timing?
They now expect to get 50% of the total planned cost synergies realized in the second half of this year, 2025, and then the full 100% realization during 2026.
Getting those savings locked in early is huge. That de-risks the earnings outlook for next year quite a bit.
Absolutely. It gives the market more confidence in their 2026 forecasts and, frankly, supports the valuation.
Okay, let's zoom out a bit now. Strategy, how they're deploying capital, what this all means for investors. One thing about FBK, they've often run with relatively high capital levels. How are the returns looking alongside that capital discipline?
Yeah, they maintain strong capital. But the returns are holding up well. The adjusted return on tangible common equity, ROTCE, hit 14.7% in the quarter.
14.7% ROTCE. That's pretty solid for a regional bank, especially one that's, as you say, carrying a good amount of capital. What's their tangible common equity ratio, the TCE ratio, running at?
It's still strong, north of 10%, which, leads to that question, is it too much capital?
Right. It means safety, resilience, which is great. But does it also mean they're maybe leaving some returns on the table by not deploying it more aggressively?
That's always the balancing act for bank management. They clearly view that strong capital base, and the tangible book value per share is up to $29.83 now as a strategic weapon. It gives them flexibility.
And are they using that flexibility? How are they deploying capital?
They are. We saw them buy back $24 million worth of stock during Q3. And as we mentioned, they paid down that $100 million in sub-debt. So they're being active, just maybe selective.
Okay, makes sense. Let's talk growth then. If capital's the fuel, what's the plan for the growth engine? Organic loan growth in Q3 was $156 million? No, 5% annualized.
Yeah, around 5% annualized.
Yeah.
Solid, but maybe not spectacular on its own. It was mainly in areas like residential real estate, owner-occupied CRE, some consumer lending.
So how do they get from that 5% run rate to what they're guiding for next year? I recall the guidance for 2026 was more ambitious.
It is. They're guiding for a return to the high single-digit to low double-digit organic growth range for 2026.
High single to low double digits, that's a pretty confident forecast coming off 5%. What gives them that confidence?
They talked about having the strongest loan pipeline they've seen in about 2 years. They feel the market disruption caused by, higher rates and maybe some competitors pulling back is creating opportunities for well-capitalized banks like them to step in and win business.
Interesting. And is M&A still part of the growth plan, even after just digesting SSBK?
It sounds like it. But the focus seems to be slightly different now. They mentioned looking for acquisition opportunities outside their current main footprint.
So expand geographically rather than just getting bigger in their existing markets.
It seems to be the idea. Capture growth in new areas where there might be disruption while letting their current markets focus on that organic growth acceleration we just talked about. Minimizes internal disruption, potentially.
And what size deals are they thinking about?
They gave a target range for potential acquisitions. Banks with assets roughly between $3 billion and $6.7 billion. So bolt-on deals, not necessarily another huge transformational merger right away, but they clearly feel they have the capacity, both capital-wise and operationally, to do another deal if the right one comes along.
Got it. Okay, last piece of the puzzle, funding and credit. How did those look? Credit quality first.
Credit looks very stable. Really clean. Net charge-offs were minimal, just 5 basis points annualized in Q3. Basically a non-issue right now.
Good to see. And on the funding side, deposits are always crucial.
Yeah, and the deposit story was actually quite strategic this quarter. They made a conscious effort to improve their funding mix. Well, they actively shed about $132 million in higher cost, non-relationship funding, specifically some broker deposits and public funds. That's smart liability management, getting rid of expensive, potentially less stable funding.
Okay, so they let some costly deposits run off. What did they replace them with? Did they shrink the deposit base?
No, they actually grew deposits overall. While shedding those high-cost funds, they ran a successful retail deposit campaign that brought in around $320 million in net new core deposit balances.
Wow, $320 million net new core. That's impressive in this environment. Do we know what kind of rates they paid for those?
They mentioned the rates on those new core deposits came in around the low fours, generally tied to Fed funds. So still reflects the higher rate environment, but importantly, it's core relationship-based funding.
And that ability to remix the funding base, shedding expensive money, bringing in core deposits, that must give them a lot of confidence in that 3.80% to 3.90% IM guidance we discussed earlier.
Exactly. It underpins the whole margin outlook. It shows they can manage funding costs effectively, even when competition for deposits is high. It adds a lot of credibility to their forecast.
Okay, makes perfect sense. Now, before we go further, we absolutely have to state our standard disclaimer. The discussion that follows is purely based on our interpretation of the earnings call and related materials. It is definitely not financial advice, nor should it be taken as a recommendation to buy or sell any security. This is purely for informational and... Okay, so what's the speculative, let's call it an outrageous but plausible trade idea based on that?
Well, the idea would be maybe an opportunistic short-term long position. The bet isn't just on the solid fundamentals, it's on management acting quickly with that newfound flexibility.
Acting how? What's the catalyst you'd be looking for?
The bet is that before the end of this year, 2025, management uses that accelerating capital build for something significant. Maybe it's announcing a much larger stock buyback authorization than the market expects, really leaning into that strong TCE ratio.
Okay, boost the buyback.
Or they announce a bolt-on acquisition, perhaps one towards the upper end of that $3 billion to $6.7 billion target range they mentioned.
So deploy capital quickly either through buybacks or M&A, potentially sooner than expected.
Right. Either of those moves, if announced before year-end, could significantly accelerate the EPS accretion beyond what's currently baked into the 2026 guidance. It could force a re-rating of the stock, compressing the valuation multiple pretty quickly.
So it's essentially a bet on management shifting from integration mode to offense mode, fueled by the successful execution we saw this quarter.
Yeah, a bet that the speed of the merger integration translates directly into faster capital deployment than the market is currently anticipating. Again, purely speculative, not advice.
Understood. Well, that wraps up our main deep dive into FB Financial's Q3. I think the key takeaways are pretty clear. Strong execution on the merger, rapid integration, getting those structural margin benefits, solid adjusted returns, and building capital flexibility pretty quickly.
Definitely. The story this quarter was all about execution, proving out the merger thesis.
And you had a final thought for listeners to consider.
Yeah, just a ton to mull over. Management guided that core efficiency ratio down towards 50% by the end of 2026. That's a very efficient level. The interesting question now is, do they prioritize hitting that 50% target above all else? Or do they decide to intentionally let that ratio drift up a bit, maybe sacrifice hitting exactly 50% in order to invest now in bringing on expensive, high-performing revenue producers or teams to really supercharge organic growth?
So the tension between maximizing near-term efficiency versus investing aggressively for faster top-line growth.
Exactly. That choice hitting the efficiency target versus potentially higher, faster growth could really define how the market values FBK over the next couple of years. It's something to watch closely.
A great point to end on, something for everyone to think about. Thanks for joining us for this deep dive on FBK. We always appreciate hearing your thoughts, too.